Vendor relationships and bank relationships are two universal finance high leverage points. In this fifth installment of my 5-part series on 10 entrepreneur high leverage points, I'm going to review how building solid long-term vendor and bank relationships sets the foundation for high leverage finance policies. My name is Brant Friesen. I work with company owners and their teams to identify the high leverage points in the systems making up their operating, investing, and finance activities. Working together, we design and implement high leverage policies to take advantage of the high leverage points and maximize profits, cash flow, return on equity, and company value. A disclaimer here. 3D rapid test and validation simulations will be used in this video to illustrate the effects of high leverage finance policies. The 3D simulations you'll see in this video are run on the Profit Lever Pro Simulator SaaS. I'm the founder of Profit Lever Pro Simulators, and I designed and had the Profit Lever Pro SaaS built to my specifications. The theme, or high leverage policy, for the two finance high leverage points is building long-term relationships. In too many cases, companies adopt a culture of taking their vendors and bankers for granted, or worse yet, treating them as adversaries. This is a shame, because in good times and not so good times, your vendors and bankers should be among your best partners. Both vendors and bankers invest in their customers and clients. And while it's true they need to invest in customers and clients to be in business, they can choose not to work with a company. The high leverage policy here is to have such good relationships that you, together with your team, are considered to be the best customer your vendors and bankers work with. Strong vendor and bank relationships leverage all three of your operations, investment, and finance activities. Both vendors and banks grant credit to your company. They allow you to use their money in your business. Later in this video, I'll run you through simulations showing the tremendous lift you can achieve from bank funding. The 3D simulations will show how bank funding is less expensive than using your equity to fund investments and cash payouts to shareholders. Vendor relationships start with establishing a fit between your need for products and services and your vendor's capability and capacity to provide the products and services you need. This starts with you and your vendors sharing each other's plans. You both need to know you can keep up with each other, and you need to know what is up and coming in each other's worlds. Your vendors can be coming out with new products and services and new ways of delivering products and services. You can be changing your operations workflow or making changes in your product offering that you need your vendors to adapt to. The plan sharing between you and your vendors doesn't need to be formal. All you need to do is maintain an open dialogue. The next high leverage policy for building positive relationships with your vendors is paying them on a timely basis. Paying your vendors on time makes them more sustainable and makes it easier for your vendors' team and your team, not just the accounting team, to administer the account and maintain a positive relationship. Now for the price element of the vendor relationship. Your goal is to work with vendors who provide the benefits you need. As part of your vendor qualification process, you'll generate a value equivalency line for all the vendors who provide the benefits you need. This veil will show you the range of prices between your qualified vendors. After the qualified vendors are ranked for best fit, you can negotiate prices. More than likely, your qualified vendors know where their pricing sits on the veil relative to their competitors. They'll know who is more or less competitive on price, so they'll know who they can lose the account to if the buying criteria is only price. You can use this intel to put your price negotiations into perspective. Now let's look at bank relationships. Bank relationships also start with establishing the fit between your needs for products and services and the bank's product and service offering. Banks operate on a portfolio model. They establish industry-specific groups to service markets where specific industries have a significant presence. In Alberta, Canada, there are bank groups tailored to the massive oil and gas industry operating in the province. In British Columbia, there are banks with media and entertainment groups catering to the motion picture production and post-production companies operating in the province. A bank's portfolio of industry bank groups can include retail, distribution, manufacturing, construction, property development, mining, agriculture, hospitality, technology, infrastructure, and as mentioned, oil and gas and media and entertainment, to name a few. You need to have a relationship at the highest management level with a bank group that best fits your industry. After finding the bank and team that meets your needs, the next two issues you need to acknowledge are: first, banks lend into plans. Second, Your relationship manager at the bank needs to sell your plan to their managers and the bank's risk management team. To move your credit and service request forward, the bank needs to confirm the following conditions. The countries and regions you trade in are politically stable with a strong economy, your industry is profitable and sustainable, your company has a history of profitability, positive cash flow, and a good return on equity, your plan makes sense and is achievable, and you and your teams have the expertise, capacity, and management skills required to execute your plan. Now, if your company is in startup mode and you can't tick the third box, banks will still pay attention to you when conditions 1, 2, 4, and 5 are in place. You work with your relationship manager to get ahead of the process, to anticipate all the asks the bank team will have about the credit facility you and your relationship manager are putting forward. The programs and products the bank will offer fall into 3 categories: lending products, treasury products, and digital banking platforms. The lending products will correspond to the turnover or economic useful life of your investment in assets. Operating lines correspond to your current assets, cash, accounts receivable, and inventories. Lease lines and equipment loans correspond to the economic useful life of your hardware and equipment assets. Mortgages correspond to your land and building assets. Subordinated or mezzanine debt is used for mergers and acquisitions. Treasury products such as GICs are used to earn interest on your cash reserves. Digital banking platforms are used for account transactions and account and loan balance reporting. Account transactions include cash receipts from customers and electronic payments to vendors and government agencies for payroll, withholdings, corporate tax, value-added tax, and bank payments for leases, loans, mortgages, and for subordinated debt. There are 3 benefits of having a running dialogue with your bank relationship manager. The first one is fast response to your needs. When you and your team have a regular dialogue with your bank relationship manager, they and their managers and support teams can respond to your needs faster because they're always up to date on your story. Second, sharing industry intelligence. During a regular dialogue, there's a sharing of industry intelligence, such as market demand and trends in product and service development, and economic forecasts. Third, future support for new ventures. The working relationship forged between you and your bank relationship manager will carry forward to other enterprise opportunities you may choose to pursue in the future. Last but certainly not least, your bank relationship needs to be set up to take full advantage of the fact that bank lending is the least expensive form of financing. Now let's look at how bank financing is more efficient than equity financing. Banks make money by charging account and transaction fees, but their primary source of revenue is the interest they charge on loans. Companies can resent paying interest on their bank loans, but I'm going to show you by way of 3D rapid test and validation simulations how using the bank credit you've negotiated allows you to both maximize your company's return on equity and maximize the dividends and other cash distributions you'll receive. Let's look at 2 simulations for Cascade Closets. Cascade Closets is a make-to-order custom closet manufacturing company. Cascade is a 2-part bank credit facility, a $2 million operating line at 4% interest, a $12.9 million term debt facility at 7% interest. Here are the assumptions we'll test in our Profit Lever Pro simulations, run over 3 years, from 2025, 2026, and 2027. In Simulation 1, Cascade will only make the scheduled payments on its term debts. There'll be no effort to accelerate the paydown of the debts. Also in Simulation 1, Cascade will pay out as much as possible in dividends to shareholders without going over its $2 million operating line limit. In Simulation 2, Cascade uses the cash generated in its operations to accelerate the paydown of its term debt rather than paying any dividends. The operations are the same in both simulations except for the interest earned on cash deposits and the interest expense related to the term debt balance. Let's check the box scores from the Profit Lever Pro simulations. We see in Simulation 1 how Cascade Closet's choice to use the bank credit allows them to pay out $4.5 million in dividends to shareholders over the 3 years and generates a 54% return on equity. Simulation 2 is the more conservative approach. The shareholders don't receive dividends over the 3 years, and Cascade Closets has $540,000 more net income because the bank debt was paid down to $7.4 million, and this reduced the interest expense over the 3 years. So, While the net income is higher over the 3 years, Cascade Closets only generated a 29% return on equity, and the shareholders didn't receive any cash distributions. This concludes our review of vendor relationships and bank relationships, the final installment in my 10 High Leverage Policies for Entrepreneurs series. Thanks so much for watching. I'll see you next time.